Will the University of Michigan Employment Survey be the next 42 macro Fab 5 recession signaling indicator to breach its recession signaling threshold? So we're not quite at a recession signaling threshold yet, but obviously if we keep moving, 1 to 2 more months could easily cause this thing to breach its recession signaling threshold and go from a low probability of developing a developing recession U.S. economy to a high probability of a developing recession U.S. economy. We currently have a high probability of a developing recession in the U.S. economy from the perspective of the temporary employment indicator. This is currently down here is the 3-month annualized rate of change of temporary employment, and at minus 5.1%, we are below its recession signaling threshold. We are still gainfully above the recession signaling threshold in terms of the Conference Board's labor survey differential, as well as the continuing claims total labor force ratio. We're kind of getting close from a cyclical unemployment perspective. So the next jobs report could push the cyclical unemployment below its recession signaling threshold or above it. It's the y-axis is inverted. So make it breach its recession signaling threshold. And then, maybe the next 1 or 2 University of Michigan employment surveys could potentially push this thing across its recession signaling threshold. So we can go from, over the next 2 months, we can go from a low probability of a developing recession in the U.S. economy to a high probability of a developing recession in the U.S. economy if the data really deteriorates significantly over the next couple of months. So again, we're not predicting whether the data significantly deteriorates over the next few months because we don't care about the outcome. Again, you have to disassociate yourself from the outcome of financial markets and the economy. I don't care what happens in the economy. I don't care what happens in asset markets. I just want to be long the things that are going up and short and or out of the things that are going down. I don't care what path the market takes over the next 2 months, 3 months, 4 months, 2 years, 3 years, 5 years, 5 years. That's not my job to figure out. My job is to make money. Those are 2 very different things. Making money is not the same as predicting where the market is going. Making money is being long the things that are going up and not as short and or not in the things that are going down. That's it. That's it. You don't need any predictions. Jim Simons, RIP to the greatest investor of all time by a country mile. RIP to him, sir. And thank you for all the contributions you made to finance. Never predicted a thing in the entirety of his career. He had no idea where markets were going. He had no idea where the economy was going, but they made more money for themselves and their investors than anybody else in the history of investing by a factor of like 1 million. like the next closest person, King Griffin, is not even comparable. And so I just want to make sure you guys are aware that the best investors of all time don't base their risk management on predicting where everything is going. They base their risk management on observing where everything is going. And that, in my opinion, is the significant difference between what the average investor is doing and what the best investors are doing. And what we're trying to do here at 42 Macro, to the best of our ability, is deliver you research solutions and risk management solutions that emulate the best investors, not the average investor.